How do you get the most from Social Security?
This is Retirement Revealed, where Jeremy Kyle and his guests guide you towards making smarter retirement, investment, and tax planning decisions.
Welcome to Retirement Revealed. I'm your host, Jeremy Kyle, and we're here to turn your retirement savings into retirement income. Today, I'm answering your Social Security and Medicare questions. Of course, you might be wondering, how do you ask Jeremy a question? Way to do that is go to retirement-revealed.com. Go to the top right and you'll see a place that says Ask Jeremy a Question. So you can go there. Or if you're watching on the Mr. Retirement YouTube channel, then go ahead and put your question in the comments. The first question is, I turned 67 in January. My wife will be 62 in October. She does not have Social Security on her own. We both expect to live to 82. When should we each start? We are not dependent on Social Security. Well, I've got a few things to go through here. One of them is this thought of we both expect to live until 82. You might have that expectation. Seems like everyone I talk to has a thought on how long they're going to live, but oftentimes that thought is not truly based in statistics and science. And I'd encourage you to go to longevityillustrator.org to find out what your actual life expectancies are. I'm curious where you got that age 82. So go to longevityillustrator.org, find out what your individual life expectancies are. And here's what's interesting about it all, is that if you believe that you have an average, and there's two of you, and that average, let's say, is 82, well, on average, one of you will be below average, one of you will be above average. So you've got to look at these averages and decide, okay, yes, I know my averages, but chances are one's going to be below, one's going to be above the average, which would be longer than you're expecting. So keep that in mind. Another thing is that let's just go with 82, and they're both looking at age 82 as how long they might live. Well, they're 5 years older. One of them is 5 years older than the other. So if you both get exactly to 82, when the one stops at 82, the other one keeps on going for 5 more years. So your surviving spouse benefits, your surviving spouse will be living 5 years on this decision. So you got to keep in mind that as well. This other part of the question is, when should we each start? Well, she can't get her own benefits. So chances are she would actually start when he starts on there. And think about this. There's really no reason for her to wait, because her benefit is at least half. It's dropping by more than half compared to what his is. And you've got a big benefit, a small benefit. They both grow at an 8% rate. So would you rather have the small benefit grow or the bigger benefit grow? You would rather have the bigger benefit growing. Focus then on how do you grow the bigger benefit, which will likely mean, in this case, he'd be waiting. And of course, because she can only get a spousal benefit, she can't turn on her benefits until he files. So as much as you might be wanting to get her a benefit, he's got to file for her to get that benefit. And waiting is going to be a big help for you. So you want to take a look at waiting for him. Now, you also mentioned, too, you're not dependent on Social Security, which means you likely have some other money. It's likely traditional money, IRA money, 401k money. And if that's the case, you probably have a bigger RMD. So here you are at 67 for you, the older one, and you're maybe looking at waiting. 70 is the latest you can wait. Well, 73 comes along, and when 73 comes along, you'll have these required minimums that turn on. And you've got now, if you wait on Social Security, you've got a maximum of 3 years to do these Roth conversions before your Social Security turns on. So that gives you 3 really good years. And that includes 2024 and 2025, when right now the law says that the taxes are lower in 2024 compared to 2025. So remember, step one is to actually get your own specific longevity estimate through longevityillustrator.org. And then the other parts of it are, remember that it's the survivor benefit that really matters. And of course, if you don't need the Social Security, it's because you probably have other money. and that probable other money is probably in a traditional type of account, and take a look at this time between now and when you do file as a chance to do Roth conversions. Second question is, I will claim Social Security when I turn 70 on December 22nd. Will I receive my first check in December or January? Will my Medicare come out of that? Now here's a lot of things to keep in mind with that. Yes, you mentioned your birthday, December 22nd. It almost doesn't matter terribly too much which day of the month. It's just that is now your Social Security month. So if you file for Social Security in December, that is your Social Security month. That's the month that matters, whether your birthday is the 2nd or the 22nd or the 31st, whatever that might be. Now, I said the 2nd, which is interesting, because oddly enough, the way that Social Security and Medicare look is they say you're eligible the day before your birthday, which is odd, but that's the way they do it. So if your birthday is on the 1st, keep that in mind, especially for Medicare. We'll talk about Medicare in a bit, but keep that in mind. If your birthday is on the 1st, your eligibility month is actually the month before. And that's why it's kind of confusing, because when you earn money for December, when you earn your Social Security in December, you get paid out the following month. You get paid out in January because you have to live for the full month to actually get paid out for Social Security. So it is quite confusing where Medicare, whether your birthday is on the 2nd or the 31st, starts on the 1st. And Social Security, whether your birthday is the 2nd or the 31st, gets paid out the following month. So I understand why you're asking that question, but you've got to live the full month to get paid out the next month on your Social Security. And that's an interesting thing where the question now is Medicare. Will my Medicare come out of that? The answer is yes. There's a rule that says Medicare must be deducted from Social Security if you can be, which means for this person now, they're not getting their Medicare deducted out of their Social Security because they're not on Social Security. So when you sign up for Social Security, there's a few different ways that you can pay for it and when you're not getting Social Security. One of them is to create a Medicare account, and you can pay by credit card, your checking or savings account, so you can go in there all the time. Or you could set up another way is to take your savings, your checking account, your bank account, and on your online bill payment, have it set up to maybe pay out every month, every quarter. Another way, which is my preferred way, is to do Medicare Easy Pay, where it's just automatically deducting the premiums from your savings account, your checking account, whichever bank account it is. It usually takes it out on the 20th of the month. But it's nice when you have something so important as Medicare to have it set up where it's just being paid every single month on a monthly basis. And then the last way, which is how most people do it, my least preferred way, is to actually mail your payment to Medicare. Seems like when I hear people complaining about financial matters, a lot of times they're complaining about the checks lost in the mail, the IRS takes forever to do things, Social Security, Medicare are hard to get a hold of, and you combine all those together when you mail your payment to Medicare. So as much as you get a bill and you may pay it in, send it in every single quarter there, that's my recommendation not to do that. I would suggest making use of Medicare Easy Pay. And of course, here's this person hitting age 70, turn on Social Security, and they won't have to worry about that anymore. I tell you, that's one reason people sign up for Social Security early is they just hate writing the check out, and they want to have it come out automatically from their Social Security. It does make life easier, but I'd encourage you not to have that as a part of why you sign up for Social Security, is that the ease of now you don't have to write the check. It's all the same dollar amount. So if you want to make it easy, go ahead with Medicare Easy Pay. Now the third question is related to Medicare. And Medicare and Social Security somewhat go together because it's Social Security that really handles the payments, the administration of all the money with Medicare. And that question is, we have to pay extra for Medicare this year. Is it every year? How is it calculated? And can I avoid that? So all questions that go into one. And it's really interesting. What they're talking about is something called IRMA, Income Related Monthly Adjustment Amount. It's a handful. That's why you call it IRMA. And what it really means is that if you have a high enough income amount, you have to pay extra for Medicare. The way it works is they take a look at your income 2 years ago and say, based on your income, if it's high enough, you pay a certain amount extra in Medicare. For 2024, that amount is $103,000 if you're single, $206,000 if you're a couple. So a lot of questions to get is, why do they look 2 years ago? Well, think of January of a specific year, right? It's January, and you haven't filed your tax return yet. Now think of this. If it's January of 2024, you haven't yet filed your taxes yet for 2023. How does the government have any idea what your income would be for the prior year? But they do know what your income was 2 years ago, because you definitely have filed your taxes for 2 years ago by the time it hits this year. So that's why they have to look back 2 years ago. So 2 years ago, you had a certain income out. It's going to affect this year. So 2022 affects 2024. 2023 affects 2025. So that's how they take a look at the income. And when they take a look at this income, they throw it up against a chart. I'll put the chart in there. And if you go above a certain level, then you pay extra for your Medicare. And there's different levels that are in there. So you want to keep in mind these different levels. And it's interesting because it's actually a range, right? And I'm going to go with the single individual. That's easy to think of. But if you go above $103,000, anywhere between $103,000 of income for 2024 and $129,000 of income for 2024, anywhere in there, that's that first level of extra amount. And because it's a range, that's why it's really important to keep this in mind, because you have a lot of control over your income in retirement. If your normal income every year might be $110,000, you're going to be hitting the middle of that range every single year. Well, think of that $110,000. You got $110,000 this year, $110,000 next year. If you can do it this way, and quite often you can, because a lot of times your income is coming out of your investment accounts, you're better off with $100,000 one year and $120,000 the next year, right? You get the same $220,000 over the 2 years. It's just if you had $100,000 in the first year, you didn't hit the range. And if you get $120,000 in the second year, you're in the same range as you were before. So you can really plan this out, that if this is going to happen to you time and again, you're in the middle of a range, and find a way to be below the range one year and then in the same level towards the top of the range that year. So you've got this control. You can plan this out to say, okay, what I'm doing this year is going to affect 2 years from now. Let's plan this out. Now, another question is, can I avoid it? Well, you can somewhat avoid it through planning it out. Planning out even ahead of time. You ought to be projecting out what your income is going to look like, especially when you hit required minimum distribution ages. That's a lot of times when this IRMAA extra Medicare starts coming in. And ahead of time, start doing those Roth conversions. Ahead of time, before you are on Social Security and Medicare, start looking at those Roth conversions so that perhaps this never affects you. Although usually when people ask me the question, can I avoid it? You're probably thinking of, can I get rid of this year's extra? And you can, but there's only 8 exceptions. It is, what if you become married, right? Let's say you make $120,000 and you're single, and it affects your IRMAA because you're single, but you get married for the year, your spouse makes $40,000. Well, now you're at $160,000 combined, and you're now in the married range, which is at $206,000. You're well below that range. So you might have had the extra cost if you're single, but now you're married, and it's affects you differently. So if you get married, if you get divorced, it could be the opposite there. If your spouse dies, work stoppage, what if you retire? Work reduction, what if you go from full-time to part-time? These are all things that happen quite frequently. These all are kind of parts of retirement, and you can go ahead and appeal. I'll put a link to the show notes where you can appeal that IRMAA, that extra amount. Some other ones are loss of income-producing property, loss of pension income, and the final one is called employer settlement payment. Now, it's on there. I've never seen it happen before, and so I looked it up. It says the settlement payment has to be a result of an employer or former employer's closure, bankruptcy, or reorganization in order to qualify as a life-changing event under this category. So I can't imagine what employer goes out of business, goes bankrupt, pays you money to the point where it's a life-changing event, and then you get to account your Medicare income as lower, but it's on there, and apparently it happened enough times that they put it on there. So take a look when you get that notice that you have to pay extra from Medicare and plan things out. I'll tell you some things that doesn't count towards appealing Medicare. One of them is a one-time withdrawal. I took out $100,000 from my IRA because I had to buy a car and fix up the house. That's not fair. Well, it might not sound fair, but that's not one of the 8 life-changing events. Or I sold a stock. That's not a life-changing event, right? There's these things that will affect your income that you've got to think of it ahead of time. And if it's after the fact, it's got to be one of those life-changing events that are on there. So we've got here our questions on Social Security, which is when's the best time to file for Social Security, especially with an age gap, especially with the spouse amount. Then how does Medicare work with turning on Social Security? How does it come out of there? And of course, this extra for Medicare. If you've got questions on things like Medicare, Social Security, reach out by going to retirement-revealed.com. Top right, ask Jeremy a question, or of course, ask your question in the comment section on this video in our Mr. Retirement YouTube channel. Thank you for listening to the Retirement Revealed podcast. We believe if you know more about your money, you will feel better about your money and you will make better money decisions.